Welcome to another episode of the STR Sisterhood. This is Stacey St. John, and I am especially grateful to be spending a few minutes with you today. Thanks for inviting me into your home, or your ears, or your car, or your gym, wherever you are listening. Now, before we dive into today's episode, I want to share a quote with you that I read that resonated with me. And this says, "How wonderful is it that nobody need wait a single moment before starting to improve the world." Let me read that again, and let's just really hone in on what these words are saying. How wonderful is it that nobody need wait a single moment before starting to improve the world? Those beautiful words come to us from the one and only Anne Frank. And I hope that you take those to heart, because changing the world to a brighter and more positive place starts with each of us every day. All right. Now, today we are talking all about mortgages and short-term rental financing. And we are here with the one and only Parker Borofsky, digging into her amazing expertise and knowledge. So without further ado, let's dive into my conversation with Parker. So today we are here with Parker Borofsky, and we are talking all things short-term rental mortgage and finance. Parker, thank you so much for being with us.
Thank you so much for having me. Really excited. You've got such a great podcast.
Oh, thank you. So I'm excited to have this conversation because I think the topic of financing your properties is kind of a stressful topic for many. And so I'm really excited to kind of peel back some of the layers and talk creative strategies. And before we do that, though, I wonder if you could let me not put the cart in front of the horse. Let me start out and have you share with the audience a little bit about who you are and what you do.
Absolutely. Thank you. So I am Parker Borofsky, and I am Wealth Builders Mortgage Group. So we are underneath Movement Mortgage, but we are a specialized team in short-term rental financing. And I have financed over 2,000 short-term rental transactions, over $1 billion in volume. And I'm in the thick of it with all you guys out there. So I also own 12 short-term rental properties, everything from renovations to turnkey and all the craziness, systems, you name it. Like I've been there, done, but maybe not everything because there's always something new.
Yeah.
But yes, so also an investor. So I am a seasoned short-term rental specialized loan originator with a specialized team, and then also an investor myself.
So how did you enter into the world of short-term rentals and short-term rental mortgages? I'm curious, like which came first and how did you get started?
Yeah, that's a great question. Great story. So I started originating loans just in general back in 2016. And then in 2017, I'm in Knoxville, so close to the Smokies. And this is right as the Smokies boom was kind of happening. And so then I connected with somebody a lot of you know out there, Avery Carl. And I actually was her loan originator. And this was before she even became an agent. So she was working at a marketing firm in Nashville, a music marketing firm. And so after they closed on their second or third, she then decided to become a real estate agent. And so I was her preferred lender. And it's really cool. So she started getting friends and family. And then there were some people that stayed at their cabins that were interested. So I started doing these deals. And, kind of one of those, look, I did my Amway days, right? I was, so the whole, too good to be true concept. So at first I was like, I don't know. But then I noticed that these clients would purchase more than one. So then they'd come back to me for number 2 and back to me for number 3. And so a little light bulb kind of goes off thinking, all right, well, they're purchasing multiples, so there's probably a reason. And then I would get to see their bank statements to do the next loan. And then, I could do the math. So I knew what their payments were and I could see all these Airbnb deposits coming in. So once I saw that, realized it wasn't too good to be true, I was like, all right, we've got to do this. And so that's when we got started. and then easily got addicted.
I say, having and launching a short-term rental is like having a baby. It's somewhat of a painful process for a short amount of time, but then you pop out that beautiful property and you're like, oh my gosh, when can we have another one? Yes. It's so fun. So fun. Okay. So you started lending first, and then you got to peel back behind the curtain to see what was actually occurring and thought, I need to get into this game.
100%. Absolutely.
And so talk to me real quick about where are your own properties located?
So we've got 8 in the Smoky Mountains. We have 2 in Sevierville, and then the other 6 are in Townsend, which is about 30 minutes outside of Pigeon Forge. It's the peaceful side of the Smokies is what they call it. This is where Cades Cove is located. We actually have about 700 feet of river frontage, so people can fly fish. There's tubers we can watch in the summer. It's a really cool property. And we live in Townsend, ironically, on our property with 5 of our rentals as well. So it's a cool setup. And then the other 4 are spread out on the Emerald Coast of Florida. So we have a little condo on 30A, a house in Miramar Beach, and then 2 townhouses in Navarre Beach, which is near Pensacola. And I kind of think of Navarre as the Townsend of the Emerald Coast.
I always say when I have been to Destin before and you see that water, it is just mind-blowing that something could be that beautiful and it's within a few hours drive. I mean, it's 12 hours from me, but it looks like the Caribbean water. It's amazing.
Absolutely. I remember seeing the first time I saw the crystal clear waves, it was almost like waves of glass. Because, on some days it's just that awesome. Yeah.
I love it. So you have now kind of gone full force specializing in doing financing for short-term rentals. Talk to me a little bit about, what you're seeing in the market. I think a lot of folks, perhaps when they're thinking about their next property acquisition, there's a little bit of fear running through their brain because they've seen interest rates on the rise for several years. They've seen home prices rising in many markets for several years. Now, both have cooled off a little bit, but, I still think that there's a sense of uneasiness out there for a lot of investors. What are you seeing in your sphere, and how is that impacting folks with getting mortgages?
Yeah, great question. It's been very different the last couple of years for sure. I think we're actually in a pretty good space right now, and I really feel like prices have come down quite a bit. Finally, especially in markets that are really heavy short-term rentals, like the Smokies. The prices there have to, because people aren't going to buy if they're not going to cash flow because there's so many investment properties. But I've also seen people explore some other markets where prices never kind of caught on to the STR market. So I think there's still a few out there as well. So I've seen everything from carefully exploring other markets, to, putting more money. Obviously, I think the newest thing is design and amenities. And I think people are having a lot of fun with that. I am kind of wanting to have fun with some of that too. So then it's a matter of, well, what do I spend my money on? Where's that return going to come in? What's going to give me the income? Yeah. So I've seen a lot of emphasis on adding some special amenities to stand out, being really careful about the markets that you go into, but finding some good pricing. Like, I'll just say it, Kentucky. I think the Bourbon Trail I have clients who have purchased in there and making some great returns. And the prices are still really reasonable. I don't feel it's gotten completely discovered. I think people hear Kentucky and go, Kentucky. So, I did at first, admittedly. So it's markets like that. So I think that now more than ever, it's just about being creative smartly.
Yeah. Yeah. And I think you're totally right. When it comes to creativity and I know there's creativity when it comes to mortgages as well. And a lot of people think about, creative financing from like a seller financing perspective or buying sub two or something like that. Talk to me about ways folks are being creative, but still utilizing, I'm going to say, traditional short-term rental mortgages.
Yeah, absolutely. I still think more than ever, maybe now those lower down payment options are important. So the 10% down second home loan, if the scenario and debt to income ratio qualify to go that route. The 15% down investment occupancy, that's the sister to that one. And the reason I think that these lower down payment options are appealing now is especially because of this design where you want to have more, where people are putting a little more money in up front. I remember, I think you got involved around the time I did, or maybe before, back in 2018, and you could just buy it, set it, and forget it. You could have grandma's furniture in there. It'll book, no worries, And so now I think there is much more emphasis. Yeah. So for those who don't have just a ton of cash laying around, I think those lower down payment options are definitely key for that.
Can you help us understand the different qualifications for the 10% versus the 15%? And what does that look like?
Absolutely. So the main factor is, the two main factors. One is intention. So the 10% down second home is meant to be a property that you're buying in a destination that you also want to use yourself, you and your family. There's no minimum number of days required. The guideline literally says some portion of the year. So if you were to go a few weekends out of the year, a couple weeks, the point there is that you're buying it to also enjoy yourself. The rest of the time, totally fine to rent it out. That one is strictly based on your current debt to income ratio. And I warn people here that make sure you have a good loan originator, because so many times I've had clients come to me, not been able to get qualified other places. I don't know how they were calculating debt to income ratio, but then we've been able to qualify them just fine. So if you feel strongly about your debt to income ratio and somebody tells you no, highly recommend you get a few other opinions before just believing it. Or somebody who will explain to you why and break down those numbers for you. Mm-hmm. Now the 15% down investment occupancy. So this is still Fannie Freddie. It's the sister to the 10% down. This one though is meant to purchase a property for income purposes. And what's cool about this one is that we can also use projected rental income to offset your debt to income ratio. So if somebody doesn't quite qualify for that 10% down, maybe they just need a little bump because their debt to income ratio is just a little bit over, then the 15% investment occupancy could be a great fit.
Awesome. Now, I am totally going to go out on a limb here, and you're going to need to correct me if I'm wrong, because I believe with the 10% option, you are required to utilize that house as the second home or a vacation home for 14 days out of the year. Is that accurate? A minimum?
Actually, no.
Okay. See?
Yeah.
What I'm talking about.
There's no, I think some places, I don't know where that came from, but
okay.
Yeah, the actual Fannie Mae and Freddie Mac, the guidelines themselves just say some portion of the year. So there's no guideline. I tell people it just needs to make sense. If you were ever audited and they were like, hey, did you really use this to use yourself as well? They know, the agencies know you're running them out too a lot of times. And that's fine, as long as you are also truly using it yourself.
Gotcha.
So, yeah.
So there's no difference in qualification with the use of the home between the 10% option and the 15% option.
Well, the 15% option, you have no obligation to stay there or to use it. Just the second home, that 10%.
Okay.
Yeah.
Gotcha.
Yeah.
So fun.
Yeah.
And talk to me a little bit about what you're seeing with people who may not have loads of cash in the bank. What are some of the ways that they are funding their down payments?
Yeah, you're so full of great questions. No, a lot of great ways. So depending on their situation, if they own their current home or when they purchased it, a really popular way is to tap into equity on an existing primary home, or if they have other investment properties, depending on when they purchased them. There's still a lot of equity out there. I see it all. In fact, I had a client today. They had $500,000 in equity in their primary and another $400,000 in a investment property they purchased like 7-8 years ago. So that's always a great way. I do recommend right now, if you have low rates on those, to look into HELOC options before a cash out refi, if that's possible. A home equity line of credit. So that's one way. Some people will borrow from life insurance policies. I think it's whole term or
universal. Yep.
Where you can borrow against that equity. Stock accounts even. So depending on like if you have a money market account or a substantial stock portfolio, you may be able to borrow against that versus actually cashing it out, creating a taxable event. So that's another way as well. So yeah, a few ways there. Partnering with somebody, if you can structure that correctly, is always a great way to do it. And then if it's a second home, you can get gift funds. So you could get gift funds from a family member to help with the down payment.
Awesome. Yeah, I think a lot of people have such a fear or a negative connotation with partnering because there are all these, of course, horror stories that you might be able to find online or hear on a podcast. But I know for me personally, I have several partners and for individual properties. And when you do it right and you vet your partners and you make sure there are clear roles and responsibilities and you put your ducks in a row, partnering can be a great option for people. So I love that.
Yeah.
Talk to me about when people come to you for a mortgage, what are some of the things that you wish they had been prepared for? So if someone is looking to potentially buy a property in the next 6 months, what should they be focusing on now to prepare for that mortgage application that's going to come up down the road?
Yeah, so I'd say the 3 biggest focal points are credit score, assets, so your cash to close reserves, and then debt to income ratio. Debt to income ratio is really important, but this can go a lot of different ways for a lot of different people. It's very complicated. I strongly urge people out there not to try to calculate themselves. Just talk to an expert because it's everything from how to average your annual bonus to can you count your current salary versus last year. Self-employment, how do you calculate this tax? There's a formula that we do on those tax returns. It's not the net amount. So debt to income ratio is big. I say just talk to a professional. And if you are self-employed or have rental properties, make sure to have your most recently filed tax return. If you don't have 23, anything about that, 23 is done. That's okay. Start with 22s. Let's see what you have there. So just having that info ready for the debt to income ratio. Credit. Oh man, if I had $1 for every time somebody didn't want me to pull their credit, I might be able to quit lending.
You'd be living in the Grand Cayman Islands right now, right?
Yes, I would. Instead of Florida. Just kidding. I don't live in Florida. But so credit. I think it's important that people are cautious of having their credit pulled. I think that's fantastic. I do want people out there to know that mortgage pulls hurt a lot less than credit card pulls. So typically, if you have a few mortgage pulls, it's not going to affect your score more than 2 or 3 points. I've told so many people this. Nobody's ever yelled at me and said I was wrong. No one's ever come back and said, no. I think the reason is, so when your credit's pulled, the system actually knows the type of pull. So if somebody goes out and tries to get 3 or 4 credit cards, I think what it does is it triggers the system to say, hey, what's going on here? Why do they need all these credit cards? What event is going on? When someone has their credit pulled multiple times for mortgage, it knows that likely they're shopping mortgages and not two things. One, it knows that they're probably just shopping the mortgage, not trying to get multiples. And two, when you get a mortgage, it's not empty debt like credit cards are. Credit cards are empty debt. That's just money you owe. There's no asset there versus mortgage. So those are the reasons that the mortgage pulls hurt a lot less. And so I just want to give people a little bit of confidence when they get out there doing that.
No, I think that's really interesting. And it makes good sense, right? Because even if someone goes and applies for 3 different cards to see maybe what they qualify for, they may not open 3. Ultimately, they may not open 3 cards, but the credit bureaus don't have any way to tell that, right?
Right. Yep. Yeah.
And I had heard, again, this was years ago, correct me if I'm wrong again, but it especially doesn't hurt when they pull for a mortgage if you're pulling within a 30-day time span. Does that sound right to you?
Yeah, I've heard that too. And, but I don't even think it really hurts outside of that either.
Okay.
I haven't known anybody that it's hurt outside of that. So, but yeah, I have heard that too.
Okay. And so talk to me a little bit about, assets. I know you mentioned that's another consideration for folks if they are looking to potentially acquire more.
Yeah, absolutely. So that's where, I don't necessarily need bank statements when people come to see what they qualify for. But having a good idea of where the money is going to come from. Are you selling a property? Are you looking to take out a HELOC? I do urge clients to be careful because I've had them get caught up in this before. If the assets are going to come from a HELOC, make sure you're far enough into that HELOC process and you've gotten your appraisal back and everything to know that HELOC is going to happen. The last thing you want is to be 10, 14 days from closing on the property you're purchasing and find out your appraisal came in way low on your HELOC and that's messed everything up. So, for an initial conversation, you don't have to have your HELOC secured, but that's something I would encourage clients to do before putting in offers on other properties. So just having a good understanding of where they're initially thinking those assets are going to come from so we can talk through it.
Now, you mentioned a HELOC would be better than a cash out refi. Talk to us a little bit about the differences for anyone who might be listening and doesn't know. And then secondarily, why is a HELOC potentially more advantageous than a cash out refi?
Yeah, so a HELOC, in most cases, a lot of times clients have primary mortgages. So they already have an existing mortgage on a property. The nice thing about the HELOC or the home equity line of credit is that is in addition to, or can be in a second place to that primary mortgage. What I like about the HELOCs is that they're also revolving. And so you can use the HELOC, pay it back, use it, pay it back, almost like a way to continually purchase properties. They're also traditionally, not all, so you have to check your terms, but a lot of them are interest-only payments. So when that comes down to debt to income ratio, it should have a minimal impact. I would always urge clients to pay towards principal, but in terms of your required payment and debt to income ratio, it's lower because of that. So that's the HELOC is typically a secondary. It can be a first lien. So if you don't have a primary mortgage on your property, you can do a HELOC as a first lien as well. And that's not a bad idea either. So HELOCs are a little more flexible versus, the other thing that's great about a HELOC is that you're only paying interest on what you've drawn from it. So if you have a HELOC with a limit of $400,000, for example, and you've only pulled $150,000, you're only paying interest on that $150,000, which is nice.
Gotcha. Versus a cash out refi, you're taking all $400,000, you're putting it in another account. You may or may not be using it, but you're paying interest on all $400,000.
Correct. Absolutely. Yep. So that cash out refi would replace your first mortgage and it would become the new and only mortgage at that point. So, in the past when rates were lower, it might have been better to do a cash out refi, depending on your circumstances. But currently, if you've got a 2 to 4.5% interest rate on your primary mortgage, when I say primary, your first mortgage, that could be on an investment property. It could be on a primary home. But if you've got a low interest rate, it may not be worth it to do a cash out refi and increase that rate substantially if you can get a HELOC.
Right.
So, yeah.
And I've heard this question asked a lot too. Is it possible to get a HELOC on an investment property?
It is. It's more challenging. So traditionally, you're going to want to go to a depository bank for HELOC. So for example, Wealth Builders Mortgage Group under Movement, we're a residential lender. So we focus on residential home loans, jumbo, conventional, DSCR, you name it. But we're not a depository bank. So we're not checking and savings and holding money. Traditionally, the depository banks are going to be the ones to do HELOC since it's revolving credit, because they're going to hold those on their books because they've got all the capital there to be able to manage that. And so that's why depository banks are typically where you'd want to go. That being said, they can be pretty conservative when it comes to investment, occupancy, and HELOCs. And so this is where if you can't find a HELOC product for the investment property, you may need to do a cash out refi on it if you want to access that to purchase other additional or do, whatever it is you may want to do. So so at Movement, we do have a HELOC product. It's not our specialty, but it does allow second home and investment properties. And so I always encourage clients that come to me asking if it's their primary home. I really encourage them to check with their local banks, credit unions, because they'll probably get better terms. But I have had quite a few clients have some great success with our investment and second home HELOCs.
Right.
So.
Right. And for anyone listening that is curious, like, ooh, I hadn't really thought about going to a different type of lender for a HELOC versus a mortgage broker. Correct me if I'm wrong. You are a mortgage broker. Talk to us about what the differences are there.
Yeah. Actually, I'm sorry to correct you.
Oh, okay. Now this is good. Okay. This is really good because if I think it, probably a lot of other people think it.
You're absolutely right. They do. I get that all the time. So Movement is actually a lender, which means we do the underwriting in-house. We do the processing. We fund it closing. We're not a third party in the middle.
Okay.
So there's some benefits, in my opinion, on that. Number one, and this is the reason I haven't opened my own brokerage. I like having the control and being with the lender,
Mm-hmm.
So the being in the middle, and that doesn't appeal to me. I need the control to make things happen. So
as the lender, sorry to interrupt you, your group is directly the lender. And so you're not going shopping multiple lenders. You're only doing it with Movement. That does make sense. I think maybe where I got confused was your Wealth Builders group. So what is a group inside of a mortgage lender?
So that's the name for my team.
Okay.
That is working within Movement. Yes.
Okay.
It was just kind of a way to brand and be distinguished since we specialize so much in short-term rentals.
I love that. And, I think that that's just so brilliant to have something that sets yourself apart. If you are part of a larger organization and you do have a specialty, I think that's amazing.
Thank you.
So I think also it's really helpful for people to understand the benefits of working directly with a lender. So you mentioned you've got the control to be able to make things happen. Yes. Are there other benefits that people should be aware of?
Yeah, I think sometimes people get caught up in you can shop other banks for lower rates. Yeah, but then there's the middleman fee. So at the end of the day, on occasion we'll get beat out by a broker, but it's pretty rare. So we don't have broker fees. we have a flat lender fee. Depending on the state, it's like $1,500 to $1,700, just a flat lender fee. And so there's no additional surprises or points added at the end other than, if they're buying points for the rate. So I also feel like it's a little more straightforward. Don't get me wrong, there's some straightforward brokers out there, not dissing brokers. But I have found in general, I like the lender model because I feel like it's just a little more straightforward, I guess.
Awesome. No, that's good. That's good. Now, I'm also curious about DSCR loans. What are you seeing in the market right now with DSCR?
Yeah, so I'll be honest, I was not a fan of DSCR for a really long time.
Why is that?
Number one, I felt it made some loan originators lazy. And I think, I'm just going to call it for what it is. I think they didn't try as hard to qualify clients for the 10 and 15% down options. And at that time, the DSCR loans were also a lot, there was a bigger discrepancy in the interest rate. There was a bigger difference. There were prepayment penalties. It just, as a whole, wasn't nearly as good of a product as the conventional. And I care about my clients. And so I didn't love the DSCR loans. I do think DSCR loans have now come a long way. And there's some really strong products out there now. We've got a great product. We have a 30-year fix. There's no prepayment penalty on it. It's in the upper sevens with a point right now. So it's a really strong one. And you can close in an LLC, which helps. I don't think it's incredibly important, but it does help when it comes together as it should. So the DSCRs are great when needed. And I still go through all the options with my clients. I'll let them know if, hey, you can do a 10%, you can do the 15, or, hey, you just quit your job and you have no income. We're going to have to go DSCR with this one.
Right.
So now that there's some great products out there, I recommend there's a lot of, or several no prepayment penalty. Right now, where we are with rates coming down soon, I highly encourage anyone out there looking at a DSCR loan to try to find the maybe 1 year or no prepayment penalty, because I think you may regret it in the near future if you don't. And
they might want to refinance, you mean?
Or sell. People forget about that part. Sometimes they don't love the property and they're in a 3 or 5 year prepayment penalty situation. You can still sell it, but then you're going to pay that penalty for selling because you're paying off the loan.
Gotcha. Yep. Yeah. You're right. A lot of people don't think about that.
Yeah. So DSCRs are good. Now, I will caution folks out there also that DSCRs are not always as easy as they seem.
Okay. Talk to us about that.
Sometimes they are. Sometimes they're great, easy peasy, breeze right through. But there's a couple aspects. I think people come to me thinking, hey, I'm going to give you my photo ID, my bank statements, and we're good. You don't need anything else. In reality, we still have, if you have current mortgages, we have to show that they've been paid on time. There's some other, we're not counting them in the debt to income ratio, but we do have to show mortgage payments have been paid on time, taxes, and all that kind of stuff. So there are some additional requirements on DSCR that I don't think sometimes folks think about. The tricky part in qualifying sometimes is the rental income. So most of these products, you can use a 12-month history. If there is one, that's great. Air DNA data, it's hit or miss. I'm sure for those out there who have rental properties, you've seen it before on your own. Some it's probably spot on, and others maybe like we have a property consistently does 120 a year, but you look on Air DNA and it's got us at 79. It's like, come on now.
Right.
So sometimes Air DNA can be tricky. And then the third route is to get an appraiser to come up with the short-term rents, which in the Smoky Mountains is easy. On one of the lakes in Michigan, where you're one of a very few short-term rentals, it's like pulling teeth. There's a lot of legwork that has to go into that. So DSCR loans are great. They can work fantastic. Just want to caution, folks out there. They're not as easy as they sound sometimes.
Right. So would it be your advice that if someone could qualify under a traditional product, that it may likely benefit them more to go that route versus, I think some people just think, oh, DSCR, oh, it's the way to go, right?
Yeah.
But they're probably paying more in interest and all that kind of fun stuff.
Yeah. And so I think that's where it's important to kind of, and this is something else I do with my clients, kind of map out like, hey, what are your goals?
Mm-hmm.
How many are you looking to purchase and what kind of time frame? How much cash do you have? And that's where you can kind of determine. So yeah, so sometimes those traditional loan products are going to fit them better. And other times the DSCR may be the best product for them. So, but I definitely think it's worth exploring all of those options.
Right. And talk to me a little bit about reserves in any of these cases. Ideally, how much would you like to see in reserves if someone is trying to purchase a property?
So these are all different guidelines based on the product. So the DSCR, oddly enough, has only a 6 months, our DSCR product, it's different out there, has a 6 month reserve requirement. So the 6 months of the subject property PITI. So it's actually not bad. That can be stock accounts. It can be retirement as long as you're able to access that money should you need or want to. We can use that. So that's a pretty good one. When you do a second home purchase, typically it's 2 months of the subject property. But then there's a tiered amount from 2 to 6% of the, it gets complicated here. Bear with me. Actually, no, not for second homes. I'm sorry. Second homes, it's just 2%, or 2 months of the subject property. Sorry. Investment occupancy, conventional is where it gets tricky. Investment occupancy, it's 6 months of the subject property, plus, depending on how many properties you have, 2 to 6% of the unpaid balances of your other investment properties.
Interesting. So if you have a larger portfolio, you have to have a larger amount in reserves across that entire portfolio. That's
correct.
Interesting.
Yes. So that's where it gets a little tricky.
What do you feel like is the biggest misconception when people come to you, and they're looking to get a mortgage for their short-term rental? What are some of those biggest misconceptions that you see people like me saying, and you're saying, no, Stacey, this is how it really is?
So a couple things. So one, I see people shortchange themselves on their debt to income ratio all the time. They come to me, in the doldrums. I can't qualify for anything. My debt to income is through the roof. It's like, okay, well, let's pick this apart here. Let's take a look. Let's see what you got. And a lot of times, like if they have other rentals, we can usually I show them how we can incorporate their existing rental income. So a lot of times they're not as bad off as they seem, and those moments are fun. On the other hand, sometimes people overestimate a little, and we got to regroup and come up with a different plan. So debt to income ratio is definitely one of them. Closing in an LLC and a layered LLC has been a thing lately. Now, there may be some DSCR. So a layered LLC is when an LLC is owned, the members are another LLC. I'm sure there are some DSCR products out there that allow this. I think most of them do not. The reason is that so DSCR loans are already very risky. So basically these lenders, these are usually getting sold on Wall Street and what have you not. But they don't know anything about who's buying them other than credit score, assets, and that this property should perform. But that person could be 5,000% debt to income ratio. Who knows, right? They could be drowning in other mortgages and they wouldn't know. So it's already very risky. And so when you close in an LLC, of course, somebody's going to have to be a personal guarantor in case of default, even with the LLC. But then when you do the layered, then it gets really complicated. Heaven forbid there ever had to be a foreclosure. And so that's why the tolerance for the layered LLCs, which I've had a lot of people coming to me lately, but not many DSCRs are going to allow that layering, because then it's going to be hard on an already risky product should they have to foreclose.
Gotcha.
So that's a misconception recently.
Interesting.
Yeah.
I was going to say, what are the chances? I know my husband and I did this early on when we bought one of our first long-term rentals, and we got the mortgage in my husband's name, but the deed was deeded to our LLC. Is that still viable in today's lending world?
Yeah, absolutely. Thank you for bringing that up, because that's another thing. Fannie and Freddie and most loan products, they do allow you to quit claim to an LLC. So if you close a mortgage in your name and the property in your name, which you have to for conventional financing, Fannie Freddie won't allow you to close in an LLC. It is actually in the guidelines. I had a client today reaching out to me saying, hey, can you send a note saying it's okay that we quit claim to an LLC? I'm like, well, no, I can't, but here, give these guidelines to your attorney. And in the Fannie Freddie guidelines, it says you can quit claim to an LLC as long as whoever has the mortgage in their name either controls or is the majority owner of that LLC. You know, really what they care about is they want whoever that debt is associated with to be in control in case something happens. That's all they're concerned about. So yeah, there's no due on sale clause in those scenarios to quit claim to an LLC, the property.
And is that something that can happen in real time at the closing? Or would that be done down the line?
That's a trickier question.
Okay.
I'd have to ask. I know some of our jumbo products are fine with that. I haven't actually asked that question on the conventional side.
Mm-hmm.
I think it depends on the state and the title company and maybe how things are recorded in those states. Now, I will say most states, it's pretty easy and doesn't cost very much to quit claim later. But there are 2 states I know of for sure that it can be pretty costly to do this after closing, and that's Florida and Pennsylvania. Because they charge transfer taxes for you to do that, which can be in the thousands.
Wow.
Yeah.
Interesting. Okay. Parker, we're getting a whole big class right now. It's awesome.
Absolutely. I love it. I love sharing. I love this.
If someone is, again, exploring potentially, I don't know if I've got the right mortgage lender, or I've been talking with a mortgage lender and I'm not sure if they're the right one for me. What kind of questions should they be thinking through? Should they be asking to help them identify the right mortgage lender?
Yeah, I would ask questions to see how familiar that lender is with the short-term rental process, second homes, investment occupancy, DSCR. If you're working with a lender who is only familiar with DSCR, you might want to talk to another one who can fill you in on some of the, whether it's jumbo or Fannie Freddie batch loans, just so you have a good understanding of all the products available. And if they're an investor, they don't necessarily have to be an investor, but if they are also a short-term rental investor, I think that helps a lot through the process. If anything gets sticky or challenging, they're going to really understand and be passionate about and fight for it, because they know in the end of the day, this should be a great income producing property. I think that helps. So we get a feel for that and make sure they're looking out for you in the long run. If they're not asking you what your future plans are or how many additional properties you want to purchase, they may not be great at kind of planning that out for you. So I would definitely ask those questions. And if your instinct tells you that you should qualify for more than what they're saying, or something, that listen to the little voice inside you. And if something tells you, okay, this is great, they seem to know what they're doing, but I'm not so sure about this, question it. Absolutely question it. Call somebody else, see what they say.
Such good advice. Such good advice. Okay, Parker, I want to move to what I call the lightning round. Okay. So I'm going to ask you to answer with the very first thing that comes to mind. First question is, where is your favorite place to vacation?
Ooh, Turks and Caicos. I love Turks and Caicos. Yes.
I have never been, but I hear it's pretty amazing.
Very amazing. I like because it's like got the small island feel, and it's got really shallow water for ways out so you can explore, and it's got yeah, it's cool. It's really cool.
Oh, how many times have you been?
3.
Wow.
Yes.
Next time you go, girl, call me up.
Yes.
I'll carry your luggage for you.
Perfect.
All right. What's one place you've never been that you want to visit? I
Greece.
hear that so often.
Really?
Yes.
Okay.
Yes.
It's a thing.
It's a thing. To like the islands, the Greek islands.
Yeah. I don't know. I love Mediterranean food. The pictures, the water. I like the dry or air. They have olives. You could ask for more than olives. I mean,
now I'm not an olive girl.
No. Okay.
Olives, yes.
Okay.
So when we get martinis in Turks and Caicos, I will give you my olives. Okay.
I'll take them.
All right. What's one thing you know now that you wished you knew when you were starting out, either in the world of short-term rentals or short-term rental mortgages?
Ooh. You got me here. So many things. There's a few things. I think we took on a couple that turned into pretty big renovation projects, and it was just a crazy time. It was COVID, and it was just hard to get. So it took a while, which was fine because I was swamped in mortgages anyway. But I think I would have had a little more foresight on what those were going to entail.
Mm-hmm.
And the renovations. And look, I love those properties now, but like one of them, I didn't do my due diligence on the front end, and it wasn't my agent's fault because I didn't even really tell them I was trying to do this, but we found this is a Florida property. Found out I can't put a pool in it because there's the whole backyard is a drainage easement. And so when I bought it, I was thinking, who would have thought you can't put a pool in Florida? I didn't even think through that piece of it. So, and it's doing great. It's doing fine. But in hindsight, I wish I had thought to check that out a little bit more. So just that renovation piece, and then understanding all the, having the foresight of what we wanted to do making sure we could do that.
Right. Yeah. Okay. What is the best piece of advice you've ever been given?
Ooh. Best piece of advice I've ever been given. What other people think of you is none of your business.
Now that's a different spin on the same concept, but who told you that? Do you know? Do you remember?
No, I'm sure it was when I was going through some rough patch at some point in my life. I don't know if it's someone I was working with. Who was that? Yeah, I don't even remember.
No, that's cool though.
Yeah, I have a very short-term memory.
Short-term memory for short-term rentals, for short-term rental loans. No.
Yes.
No, I mean, I think that's a really interesting piece of advice because what most people will say is it doesn't matter what other people think. And it is true. It not only doesn't matter, but it's also none of your business. So don't even give it a second thought. Don't let it enter your brain, right?
Yes. Yeah. And I think, and this is where, and those who are short-term rental hosts, I think, or even people in business will find that you can kill yourself and bend over backwards and do everything you can for everybody, but there's always going to be people that just don't appreciate that or aren't happy or, what have you not. And so that's where, really, and luckily, we get a lot of great reviews in mortgage. Things don't always go smoothly, but I feel like we're pretty good at keeping people up to speed and what's going on. We're not perfect. Don't get me wrong. We've made mistakes too. But yeah, I think at the end of the day, going easy on yourself, and just, you can't, it's impossible to please everybody.
Amen to that. Amen to that. Last question. What's one thing and or person that you're grateful for today?
Ooh. I am actually really grateful for my husband. because he has supported me throughout my entire career and really let me kind of be the one to shine. And yeah, he's great. He's been a fantastic backbone. So I very much appreciate my husband.
That's awesome. And what's his name?
Oh, Osvaldo Oz.
Oz. Okay.
Yeah.
That's a really unique name.
Yeah. He's from Mexico. He grew up in Mexico. Yeah. His last name is Martinez. I didn't change mine. I figure, and here's why, because people say why. First of all, he didn't care because he's amazing like that. And secondly, people already think I'm going to be a guy when they see Parker. And so I'm sure they would be expecting like a Hispanic guy. And then I show up and I'm like, hey, how's it going? It's just total opposite. And, nothing wrong with Hispanic men, of course, but it's like total opposite of me. And so, So yes, Osvaldo Martinez.
I was just at a convention last week, and this is the first time I've ever heard this, where the husband took the wife's last name. Have you ever heard of that?
I haven't.
It's a new day and age, I tell you.
I have joked with Oz about hyphenating to mine, and he's like, yeah, don't push her up.
That's great. That's great. Parker, if someone is listening and says, oh my gosh, I need to get in touch with her, I'd love to get her, helping me. First of all, do you lend in all 50 states?
I'm in 39 states.
Okay.
All the ones that matter.
All the ones that matter. So chances are
yeah.
You'll be able to help them. What is the best place for them to find you online?
So our website would be the easiest. And on there, my Calendly is on there if you want to set up a call. So the website is wealthbuildersmortgage.com.
Awesome.
Yeah.
I love it.
Yeah.
Parker, thank you so much for being with us.
Hey, thanks for having me. You're an amazing host. Again, I love your podcast. You are such an inspiration for so many women out there and men, I'm sure too, but
all one of them who listens. No, I'm kidding.
I'm sure some sneak it in, I'm sure.
I don't know. But you know what? It's so fun for me to have conversations with people that are, I feel like we're like sisters, and it's so great also to help women have a voice. And it sounds really strange. It's not that we don't have a voice, but I think so many times it's easy for there to be male-dominated conversations in real estate investing, especially.
Yep.
So I don't know. It's something that I absolutely love.
Yeah. I think you're 100% on. And I've talked to a lot of the women in your group, and they have the same sentiment. Yeah, there's some great other, mixed groups out there, but to come to kind of more of a safe space where we can all share, collaborate, talk about really cool things, it's amazing. So thank you.
Now, before you go, I want to give a quick shout out to some of the amazing women inside the Female Short-Term Rental Investors Facebook group. Just a few days ago, Michelle White posted, I'm looking to maximize my cabin rental. I have one room, 12 by 13 on the main level with an ensuite. Should I do 2 queen beds against each wall with a nightstand in between, or a king with a twin against each wall? 2 bedrooms up are a king in each. And we've had so many amazing women jump in and share their feedback. One that jumped out to me actually came from Sarah Sell. And Sarah says, I go based on your target audience. With 2 kings, you'd imagine 2 couples there. Who's coming with them? Kids, grown, or young? Another couple? I usually try to put kings wherever I can, but in this case, you're talking about a difference between 8 guests and 6 or 7 guests. What would your bathrooms or common areas support? Sarah, such great advice. Thank you so much for chiming in. And Michelle, I hope that was helpful. And with that wraps up today's episode. I hope you have a fabulous rest of your day, a fabulous week, and I will see you again very soon.